Welcome to Microcap Explosions. This is Mariusz Konieczny. We are talking oil today, and I am with me, Shubham Garg. Thank you very much, Shubham.
Yeah, thank you for having me.
Yeah, I saw a lot of your posts on Twitter. Someone recommended me your account. Very good. So I will, for those of you who are listening, I will share Shubham's Twitter in the description. But Shubham, take a few minutes, maybe introduce yourself, who you are, why are you talking about oil, and we'll just kind of get on with this interview.
Yeah, you betcha. So Shubham Garg, my background is in petroleum engineering. Um, kind of did a lot of work in the field, right from the wellhead, production engineering, facilities engineering, operating wells, new well startups, that kind of work, um, all over Western Canada. So in heavy oil, light oil, the gas fields, I really tried to get a full exposure to the entire industry. Um, been working in the field since 2013. I started my petroleum engineering. 2018 graduated, did a bunch of co-op terms, um, worked in the field after that, and I started investing in oil as well in 2013. And not the best time to invest in oil. That was kind of the peak, and lost a lot of money doing that. But it really gave me a chance to understand how the markets worked, how things were going. The big shale oil boom kind of came in at that time, and then since then, just kind of it's been stagnating. Nothing really happened in the markets, and I think all of us oil investors were waiting for like a March 2020 moment where we see this big drawdown, and you can kind of back up the truck because oil isn't going away. That's the reality that I think a lot of people are ignoring, and they throw out wrong information out there. But oil is going to be there, and I think some of us realize that. So I was working in the field at the time, and we had some layoffs. So basically, I just started working as much as I could. We kept the production going and invested every dollar I could back into the oil stocks, and did well since then. And about a year ago, I left the industry, the engineering kind of side of things, and moved full time. Took about 6 months off and traveled the America and Mexico, the West Coast, and in September, kind of went full time into investing and sharing some of the macro stuff that I track. I launched White Tundra Investments, which I do a lot of work on the oil macro. So look at the overall trends, what's happening with inventories, supply, demand, geopolitics, etc., and then tie that down to companies and subsectors of the industry, which I feel will do the best going forward, and then pick certain companies within that based on kind of in-depth research. I look at well productivity. I reach out to my contacts in the field, try to stay as connected as I can, understand the management, kind of their policy, where they're going, etc., and kind of just make decisions based on that. So that's White Tundra, and my kind of goal with that is to give as much knowledge as I can back to the retail investor and help people really understand the oil industry, as opposed to just saying it's a volatile industry and they don't want to invest in it. If they can really understand it, there's so much potential for growth and financial return in the industry.
Oh, perfect. As you mentioned a little bit about how you think oil is not going anywhere, and that's I guess that's not a popular decision, right? Because right now we're going electric. Everybody's talking Tesla, electric cars. We're not going to need oil anymore. So, like, why do you think like oil is here to stay?
Yeah, you betcha. So some of the biggest reasons that people talk about oil going away. So oil is about 100 million barrel a day market, maybe a little bit more than that now. About 5% of that is electricity generation. So when people are talking about they're going to convert the entire grid to solar and wind and geothermal and whatnot, that's 5% of the world's demand of oil, and that's assuming that you can convert all the electricity supply in the world off of oil, which is really unrealistic. It's very expensive. Some of these solar farms, wind farms, they require a lot of subsidies. Some of their shelf life is kind of overestimated sometimes. So there's that. And the second thing is that the electric vehicle model, yes, it's picking up steam. Of course, they're going to sell more electric vehicles as we go, but the reality is there's a lot of problems there. a lot of the electric vehicle sales so far have been to the higher income households who can afford kind of an extra vehicle. We don't have enough lithium, cobalt, graphite to produce anywhere near the EVs that people claim. And then battery recycling, we have a huge problem coming up with battery recycling. We saw a video about maybe a couple months ago that the guy blew up his Tesla with dynamite because he didn't want to pay for the battery to be exchanged. So I think it's still very early stages, and again, transportation is again not a huge part of global oil demand. A lot of it is diesel and jet fuel and petrochemicals, um, and many other factors that people don't consider when they just make claims that hey, EVs are just going to take over the world.
You know, I saw the graph that you had on your channel talking about how the sale of conventional vehicles are not going to peak, or are not expected to peak until like 2038. And I was thinking myself, like countries like China or India, where I mean, India is obviously further along on the development than India. But let's say you're in India, right? And you have been brought up maybe poor, and now you're moving up to the middle class. The last thing on your mind is being green and being, saving the world or whatever. You just want to get behind the wheel and drive. And
Mhm.
and if the electric vehicle costs you, 5 times as much, you're not going to buy it. You're just like, just give me whatever vehicle I have. I'm going to put petrol in it, and I just want to go. And I don't think the electric vehicle crowd. Yeah, a lot of them live in Las Vegas or California. They just don't, they can't look at it from somebody else's point of view that is not, the green world is not on their mind.
Yeah, absolutely. I think that's a great point. I think us in the Western world, we sort of have a different kind of worldview of the people. But think about it. We make up very little of the population. Between India and China and Bangladesh and Southeast Asia. I mean, and you take Africa, some of the big growth areas like Nigeria. You're talking 4 to 5 billion people who really don't care about being green. They just want a TV, they want a refrigerator, they want a motorcycle, they want barbecues, etc. So for them the petroleum demand is going to go very, very high. And India specifically, I posted something on my Twitter earlier that the EVs in India cost double what the gasoline or the diesel variants cost. So I think up there that people totally going forward and making these assumptions based on something that really is not true, to how the world as it grows is going to grow. First, they will buy petrol vehicles, the cheapest source they can buy, and then people might move into EVs in the future. And it's funny you mentioned India, because that's a place where the gasoline vehicle sales are growing by like 10, 15, 20% year over year. They were building about 5,000 kilometers of road 10 years ago. They were building 9,000 kilometers of highway road a couple of years ago. And last year, they built 13,000 kilometers of highway. So, people don't build highways for them to stay empty. This is going to be used up by big, heavy diesel using tankers, gasoline vehicles, motorcycles, etc. So there's a big demand coming that also people are not taking into account.
Yeah.
So
Okay. So this is kind of like the conversation about oil demand.
mhm.
Is there anything else you want to add about oil demand? Maybe you can tie it to the pandemic and how things developed since then before we move on to the supply side.
Sure, yeah. So based on my best kind of estimations, what people are saying out there, we are already at pre-COVID demand worldwide. We have an additional about 2 million barrels a day of jet fuel still to come. So if you look at the number of planes in the sky, you might say, well, we're almost at 2019. But the reality is that a lot of the planes that are in the sky are going from San Francisco to LA and Boston to New York and London to Paris. The short haul domestic kind of flights. A lot of the long haul flights that use up a lot of jet fuel, such as Australia to Indonesia and then Europe to America, are not online yet. So once these flights come online, which we're seeing kind of the beginnings of it, Indonesia just opened up their borders earlier this month, um, Thailand and the Philippines as well. So big market tourist destinations there, big population centers that are opening up, and you will see demand go much higher than pre-COVID levels um, from that standpoint. And then the emerging markets, people ignore the emerging markets. There's a lot of people on what they call the S curve. So as people's quality of life goes up, they go from using no petroleum, such as riding horses and walking and riding bicycles, to using motorbikes and having TVs and electricity in their homes. So the incremental per capita demand for petroleum goes up substantially. And we're seeing that now, where about 3 to 4 billion people in the world are kind of in that transition zone, and are going to add a ton of demand. And India is kind of the biggest one. They're building about 5 million barrels a day of extra refining capacity in the next 8 years. They're building 150 airports by 2030, and you can extrapolate that to nearly every country in that area, or in a similar kind of quality of life transition zone. So definitely demand is going to be much higher than I think people are not putting in the work. They're just taking pre-COVID demand and putting some sort of linear curve on it, when in reality it's going to be some sort of exponential growth for a little bit here, in my opinion.
Very interesting. Okay, let's jump on the supply side now. What's going on in the supply? Maybe you can touch on OPEC, shale production. What's happening there? Why can't the supply, just be increased?
Sure, you betcha. So since 2014, we had the big spike, and then we had kind of a sustained lower for longer period since then. And what's happened, and this is from my own anecdotal experience working in the field, and it's from what's happening worldwide, is people just are not putting the money in. There's not enough capital, first of all, to maintain production. And secondly, a lot of the maintenance that needs to be done on a yearly basis, or on every 3 years, 5 years basis, is just not getting done. It's just getting deferred. People are robbing parts and equipment from stuff that's been sitting around, instead of having extra supply kind of sitting around. So the supply side, when I look at it, I look at OPEC plus, first of all. OPEC plus is not performing. They, besides Saudi and UAE, really the rest of the countries are struggling. Kuwait in the Middle East, you want to look at West Africa, so Angola and Nigeria are down 10, 15, 20% since their pre-COVID levels. You see the American shale would be the other one, where they really are in a big mess here. Like, shale is very short cycle supply that can bring production online very fast. However, it declines. Some of the shale wells declined 75, 80% in the first year. And shale is now running into a problem where the wells are declining faster than they can bring new production online. And that's for a variety of reasons. The first is the supply chain. There's supply chain problems across the industry, from the rigs to the labor to some of the parts you need, some of the chemicals you need to get supply online. It's just a mess, across the entire supply chain of the industry, from the drilling, completions, equipment, and the tie-in process. There's a lot of gaps there. The other problem is the acreage. A lot of the shale acreage has been drilled out. A lot of the tier one high quality stuff has been drilled over the last 5 to 7 years. So the wells you're getting now have higher gas oil ratios. So they produce more gas per every barrel of oil that they produce. They have higher water oil ratios. So they produce more water for every barrel of oil that they produce. And the Permian especially, which has been a big growth factor for US shale over the last 4 to 5 years, is having a water disposal problem. They have roughly 15 million barrels a day of water that they have to dispose, produced water, and it's causing big earthquakes. It's causing pressuring up the zones that they have to drill through. And the Texas Commission has kind of stepped in to protect some of these issues, and it's just going to get bigger and bigger. So shale itself is kind of on a peak slash decline. Um, Based on the statistics I'm seeing, they're not able to add the rigs they need. They're working through their DUCs, which are drilled uncompleted wells. So wells that are sitting around that have been already drilled and they just need completions. They're going into this kind of savings of extra wells sitting around, and we're at lows again there. So, you look at OPEC, you look at shale, those are kind of the two big stalwarts of the industry in terms of supply.
You
And
know, when the pandemic happened in 2020, and
mhm,
the oil production had to be shut off like very
yes,
fast,
mhm,
I was hearing things that if you do that, you can destroy the wells. Like, is this one of the reasons?
yes, yeah. So that is another big reason is people just didn't care how they shut off the wells. And I'm speaking from my own personal experience. The order we got was, look, shut in the production as soon as possible. So we just went out there and we closed off the master valve on the wellhead, and that was that. So if you extrapolate that now to the entire OPEC plus, all the shale wells, there's a lot of wells that are not going to come back. They've caused big problems there in the geology, in the reservoir. You have paraffin and wax building up in your tubing strings. So that's another big part that can be fixed in some way. But again, you need the labor, you need the rigs, you need the equipment to go in there and fix these. So it's a very slow process, and you're seeing some of the countries in OPEC that maybe are not able to respond to issues like this as fast, and production is just declining in those countries. And you know, uh, on the other side of supply, the countries that can bring production on are basically maxed out. So you look at Saudi, you look at UAE, you look at Canada, you look at some of the growing places like Brazil, Guyana. They're basically maxed out. Canada's production is the max it's ever been. So there's not much, capacity there for people to ramp up production, and the producers that are struggling. I mean, it's been 8, 10 months since OPEC started adding production, and they just haven't been able to catch up. It just gets worse and worse. So the
And what
supply is the
about
other.
like Western governments, or maybe not even Western governments, because they want to look good for for the world, that they are being green and everything going electric. Are they
Mhm.
making it more difficult for oil producing companies bring production online?
Certainly, yes. They have been doing this since 2014, if not earlier, with their permitting. Some of the permitting regulations, some of the royalty rates across Canada and the U.S. Are kind of going up, and there's a little bit of uncertainty there. Um, the pipelines is kind of the biggest problem. If you don't build pipelines and producers don't have an access to market for their product, they're not going to bring production online. So you see this in Canada, especially. I mean, we have the capacity to add on another 2, 3, 4 million barrels a day over 4 to 5 to 7 year period. But if there's no pipelines to get the product out, you're not going to spend the money to bring this production online. So, you know, I would say it's more so in America and kind of Canadian problem, but it's also true in Europe for gas, natural gas. They've caused a big problem with bringing new natural gas production online, keeping the current fields online. They've shut in some of the fields well earlier than their actual economic life. So, um, yeah, you're totally right. There's been an overreach in a way, and it's causing impacts now that are not easy to fix. The oil industry cannot respond in a matter of months. It takes a year or 2 or 3. By the time you get the budget, you get the equipment, you go in there and you drill the wells, you get them on production, and the end consumer finally sees the impact of that.
Mm. Okay, perfect. So that's a good summary on supply and demand. Now let's
Hmm.
talk about how people can make money from it. And
Hmm.
the reason why I like talking to you is because you lost a lot of money in the industry. So you're not gonna to do stupid things. You're probably not gonna do. So
Hmm.
you learn. Hopefully, you learn from your mistakes. And
Definitely.
how do you personally want to will benefit from it? And how can others also benefit from what's happening?
Sure, yeah. So I'm always keeping a track. I have a daily checklist of daily stuff I track, weekly stuff I track, monthly, quarterly, etc. And the trend right now is down. Inventory is down, supply is stable slash down, and demand is up. As long as these trends stay where they are, I see no reason to be out of the industry. There's people talking about Biden is going to do this and that, and you can't fix the issue that's popped up here. You can't just invent oil out of thin air. And oil is one commodity that once it's used, it's gone. It's not like some of the metals where you can recycle them and bring them back. Once oil is consumed, it's gone. So this fundamental issue, as long as it keeps being sustained, I'm very happy with keeping my investments in oil. As far as how I can make money off it, basically, I'm focused on the Canadian producers, the Canadian oil producers. The reason for that is that the Canadian dollar is very weak right now. So if oil is trading at $90, let's say WTI, West Texas Intermediate, that's about $115 in Canadian. So for Canadian producers, they're getting this extra 25 to 30% boost to their revenues from that. Canada has some of the longest life reservoirs with the lowest declines, and they've spent the money up front. So a lot of these companies, they spent money in the 2010 to 2014 period to get their fields online, and now the fields, they don't decline very much, and they just print money. So that's kind of what I'm focusing on right now. The heavier oil, especially, is in a higher supply demand issue worldwide. So the heavy blends like the Western Canadian Select, the AWB Access Western Blend, there's a big supply issue with heavier oil, especially with Mexican production going down and Venezuelan production going down, which were kind of some of the biggest sources of heavy oil worldwide. So yeah,
So give me a couple of names of these Canadian producers that you like, but if you're listening to this, don't just take his word for it. Just if he says whatever names he says, just do your due diligence on them. Yeah. But just go ahead, give us a couple names that you like.
Sure, you betcha. So I can kind of share my thesis on a couple that I have and are my biggest holdings. So my biggest one right now is Surge Energy. It's on the TSX SGY, ticker SGY. It's a heavy, light to heavy oil producer. They have two of the four best fields in North America currently, is where they have exposure to. It's about 80% oil and liquids. The free cash flow to EV is kind of one of the biggest things that I look at. How much free cash flow is the company generating to its enterprise value? And free cash flow for oil companies is after they pay all their capital expenditures to keep production flat. So it's basically what the company's making after they spend every single dollar on anything to keep their production flat, operating expenses, management salaries, et cetera, et cetera. It's about 25% right now for Surge Energy. That means that they can pay a 25% dividend right now and be very stable at that. I believe I calculated that at about an $85 WTI price, which is where the strip price is right now. Their reserve value is about $19 a share. They're currently trading at 6.5. So I like the fact that they have the cash flow generation and the oil in the ground kind of both speak to the valuation of the company. The two fields that they have.
So what's the market cap to the cash flow? Is it like 4 times?
So the free cash flow right now is about $175 million. The market cap is about $550 million. So about 3 to 1 for free cash flow. If you want to look at just cash flow before expenditures, capital expenditures, it's about $325 million. So cash flow to market cap is less than 2 to 1. And the two fields that they have, which are, in my opinion, two of the best 4 fields in North America, and this is not just my opinion, this is based on research done based on the well results. They have fields in southeast Saskatchewan, which is a province in Canada, where the wells are paying out in about 55 days. So in less than 2 months, they recover the entire cost to drill this well and everything to do with bringing it on production and the rest is just pure profit. They bought out two private companies in the area in 2021. They let these companies de-risk the project, find the oil pools, find the reservoirs, and then they went in and scooped them up at a very very good valuation, about two times cash flow to the price they paid. So or sorry, two times they paid to the cash flow it's generating, and amazing reservoirs. They have about 7 to 10 years of inventory here, and it's called the Frobisher Field. They also have the Sparky Field, which is in North Saskatchewan, where the wells are paying out in about 115 days, so about 4 months. They've brought in some brand new technology using oil-based drilling muds instead of water-based drilling muds. They're now drilling multi-leg horizontals. So instead of going into the well vertically and drilling one horizontal, they now go eight horizontals of the same vertical well. Much cheaper. You get much better productivity and just raking in the cash. And a lot of their locations, which were uneconomic, have now become their top locations because of these technologies. So, an absolutely great play. Management has the CEO was the founder and kind of CEO of another company in the past, which had very, very good results. Very positive guy, very confident. I've met with him a few times, and I invest in winners. I like to invest in people who've won in the past and like to win. And I see just great things ahead for a company like this. So that's one. On the oil side, I can name another company that's more on the gas side. ARC Resources, ticker on the TSX is ARX. ARX. It used to be a gas producer in Northeast British Columbia, and Canadian gas has had a very, very bad time in the last few years, sometimes trading at negative, sometimes trading below what the production cost is. And they've had a few catalysts here in the recent couple of years. So one, Alberta has switched nearly all its electricity generation from coal to natural gas. And that's bringing kind of a floor price on gas that we didn't have before. Secondly, the LNG Canada project is going great. It's going to be online in maybe 2.5 years. And that's going to take up roughly 12 to 13% of current Canadian gas supply. So it's a big pull on the industry. The whole supply demand dynamics have changed, and natural gas is looking great going forward. And ARC has a trick up its sleeve. They did an acquisition in early 2021 of a condensate producer. So why is condensate important? Because the heavy oil in Canada is too heavy to put into pipelines. The pump seize up and they can't properly pump this oil into the US. So what you have to do is you have to blend it with condensate, which is a very, very light oil. And it's always going to be in supply because as long as you're shipping heavy oil from Canada down to the States, you have to blend it with this diluent, aka condensate. And condensate is about 400,000 barrels of supply right now in Canada and 600,000 barrels of demand. So it's always going to trade at a premium. It in fact trades at a premium to WTI oil in America. So it trades about $2 to $3 above that. And ARC produces roughly 70,000 barrels of this 400,000 barrels of supply in Western Canada. So they have a lion's share. They're making a ton of money off this condensate. And then they have NGLs, which are natural gas liquids, propanes and butanes, which they're sending to Chicago in the Midwest, selling at incredible pricing because a lot of the Midwest and Northeast US uses fuel oil and heating oil for their electricity and their heating needs in the winter. So propane is selling at a huge premium. And, they have these three streams of income: natural gas, condensates, and NGLs, all of which trade at a premium right now to what they used to. And the market just is ignoring this whole thing. So it's almost my biggest position as well now with Surge 1A, 1B. It's about a 23% free cash flow to EV, about a 3.5% dividend right now. And they're buying back 7 to 10% of the float every year. So you have great share price appreciation and you get the dividend while you wait.
All right, perfect. Well, Shubham, thank you very much for the macro view on oil, the supply and demand, and your two two interesting picks. So once again, as I said, don't you dare to buy those stocks without doing your own due diligence, right? He gave you a tip. You can follow up on that tip and do your due diligence. I will link Shabam's Twitter account in the description, so I suggest you give him a follow. So once again, thanks a lot for your time.
Yes, thank you so much for having me. Have a great day.